Hey there, and welcome back to The Explainer. If you are a focused learner trying to cut through all that wild market noise right now to understand exactly what is happening with gold, well, you are in the exact right place. Today, we're decoding the historical volatility of gold. We're going to look at a full century of booms, some pretty devastating busts, and exactly what the hard data tells us about where the market is heading next. Okay, let's just dive right into this.
So right now, depending on exactly where you measure from its all-time high, gold has actually seen a massive 30% downward correction. And let me tell you, this has prompted absolute panic among a lot of casual investors. People are staring at their portfolios, watching the price slide, and wondering, is this it? Is this the end of the gold bull run? But before we let ourselves get totally swept up in all that immediate anxiety, we really need to take a step back and look at what history tells us. Because if you think a 30% drop is terrifying, consider this. Absolutely staggering historical fact. Gold once suffered a monstrous 70% crash. Just imagine watching an asset plummet to that degree. But what's even more crucial here is what happened next. It took an agonizing 28 years, literally all the way until the global financial collapse in 2008, for gold to finally fully recover from that peak. This right here proves that gold is definitely not just this magical asset that goes up in a straight line forever.
Section 1. The reality of crashes. Let's look at historical bear cycles.
The sheer frequency of these events is really what stands out when you look at the data. Between the mid-70s and the early 2020s, we've actually seen 5 major bear cycles. We're talking 40% drops in the dot-com era that took an entire decade to recover from, or sudden 20% drops that managed to bounce back in just a couple of years. So what's the big takeaway here? Massive crashes and multi-year recoveries are basically a historical feature of the gold market. They aren't an anomaly at all.
Right now, technical analysts are laser-focused on one very specific level, the 200-day moving average, which is currently sitting around the $4,200 mark. If gold fails to sustain that incredibly crucial support level, speculation is absolutely rampant that the price could just plummet straight down to the $3,500 range. But to understand if that's actually going to happen, we have to look at the macroeconomic forces that trigger these kinds of historic freefalls in the first place.
Section 2. The Volcker Shock, a true macro catalyst.
Enter the Volcker shock. Back in the early 1980s, inflation in the United States was running incredibly hot. To combat this, the Federal Reserve chairman at the time, Paul Volcker, made a really drastic and aggressive move. He raised interest rates so high and so fast that it completely shocked the global economy. See, when interest rates skyrocket like that, investors basically abandon assets like gold, which, don't pay a yield, and instead they pour their money straight into safe, high-yielding government bonds. The end result, both the stock market and the gold market completely collapsed.
In 1980, under Volcker, interest rates were hiked all the way to 20%. Just let that sink in for a second. 20%. If you were an investor back then, you could get a massive, guaranteed return just by holding your cash in the bank or buying bonds. Now, compare that to today's Federal Reserve target rates, which are hovering right around the 3.5 to 3.75% mark. It's a massive juxtaposition. The macroeconomic environment of that 1980 crash was a completely different beast compared to what we're seeing today.
Section 3. The U.S. debt dilemma, a major roadblock to hikes.
The answer to why we aren't seeing those 1980s rate hikes today comes down to one absolutely terrifying number: $39 trillion. That is the staggering, almost unbelievable scale of the current United States national debt. And when you have this much debt on the books, well, the rules of the game fundamentally change.
So let's break this down. When you have a national debt of $39 trillion, even at today's relatively low rates, the government is paying roughly $1 trillion a year just to cover the interest. It's wild. Because of this immense burden, drastic rate hikes, like actually taking rates to 20%, would quite literally bankrupt the country. So the Fed's hands are largely tied here, which heavily insulates gold from another 70% interest rate-driven collapse.
And this dynamic brings us to a pretty profound realization from our sources. The real currency is gold. The significance of the dollar will eventually collapse. When central banks are burdened by massive debt, their primary solution is almost always to just print more money. Fiat currencies like the US dollar can literally be printed infinitely, completely diluting their value over time. But gold, its supply is strictly limited by nature.
Section 4. Purchasing power. Let's take the 100-year perspective. There's a stunning 100-year price difference from the Indian market that perfectly highlights this global shift in purchasing power. Back in 1925, 10 grams of gold cost just 18.75 rupees. Fast forward to today, and a larger equivalent, 100 grams of gold, is going to cost you roughly 14 lakhs or 1.4 million rupees. The fiat currency has wildly depreciated over the last century, while the nominal price of gold has absolutely skyrocketed.
But here's the core takeaway, the real aha moment. In 1925, that tiny amount of currency, around 18 rupees, could buy you months of groceries or even a small plot of land in a village. Today, if you take the modern equivalent value of that exact same gold, it buys you the exact same things. Gold doesn't necessarily make you instantly rich, but its true purchasing power perfectly tracks inflation. It ensures that your wealth isn't completely eroded by central bank money printing. It essentially keeps you from becoming poor.
Section 5. Trading the gold market. Some actionable takeaways.
If history tells us that gold is in a long-term uptrend despite these short-term crashes, then the strategy actually becomes pretty clear. You buy the meaningful corrections. A 15 to 20% drop in a bull market is historically an exceptional buying opportunity. And today, retail investors have some seriously powerful tools at their fingertips. You can trade gold digitally via tickers like XAU, or even use crypto-backed gold like XAUT and PXG. The source highlights utilizing platforms like CoinSwitch, where you can actually leverage daily options on gold that expire every single day at 1:30 p.m. I mean, the mechanics for entering this market have literally never been more accessible.
Section 6. The next big move. Let's check the technical charts.
Right now, a massive technical consolidation is happening. A descending triangle pattern has firmly formed on the charts. Gold has absorbed a tremendous amount of liquidity, dipping down to really test its lower limits, and is now being squeezed into a very tight decision point. The analysis suggests that a major explosive momentum shift is expected within a month, likely before August. This consolidation phase is ending, folks.
And that leaves us right on the edge of our seats. The tension is quite literally built into the chart. So, armed with everything you now know about the $39 trillion debt ceiling preventing huge rate hikes, yet facing the harsh reality of gold's historical 30 to 40% drops, what do you think happens next? Will gold break out upward to resume its historic run against inflation, or will it collapse downward through those support levels for another painful, multi-year bear cycle? Look at the data, watch those charts closely, and get ready for the next big move. Thanks so much for joining me on this explainer, and keep learning.